So this is a great time we meet again for this session today for financial reporting and analysis. So for the guys who have been attending this class, we have been doing topic per topic. That is, like now we have done the small topics, like now provision of farms, agriculture and farming activities. I'm talking about the guys who have been attending from the start of the semester. We did accounting for income taxes. We have done published financial statements, which contains the preparation of statement of profit and loss, statement of changes in equity, statement of financial position, and the cash flow statements. Now we are entering another very important topic, which never misses in any exam, and that is group accounting. The group accounting, that is the topic of today and tomorrow. So for today, we'll do a general introduction, and specifically we will focus on the areas you need to understand for you to do a 20 marks question, because it's obvious a 20 marks question. Minimum, it's an 18 marks question. So meaning that by tomorrow, you need to know that you have around 40% of the exam, not even 40, more than 50%. We have done more than 50% of what will be in your exam by tomorrow, due to what I've done in this online platform, in these online classes. And for the guys who have joined today, I welcome you. And I welcome you in the coming days. We can talk more, so that other than just coming for today's session, you continue being around, because now we have other major topics remaining, and there's a recap which will be done later on the topics which are already done. Anyway, to the business of today, the work of the day is all about group accounting. So this is whereby you find that one company has acquired another company. So you find that company A has acquired company B. He has acquired company C, or company D, or company even E. So it will be based on the percentage with the parent has acquired the other company. So let's say if we have a company A acquiring 3 companies, so company A can acquire company B, you can acquire company C, and you can acquire company D. So this one can be 80%, let's say that. This can be 50%. This can be 30%. So this company will be called a parent, or in some cases, they call it a holding company. They call it holding company. So the holding company. So a company acquired between the percentage of 51% to 100%, the one which lies on this percentage. Like now, this one, it has acquired between the percentage of, it lies in between the percentage of 51 to 100. So this one would be called a subsidiary. This one will be called a subsidiary. A company which is acquired exactly at 50%, this one will be called a joint venture. One is called a joint venture. Then the one which is acquired and the percentage of acquisition lies between 20 to 49%. So this one is called an associate. This one is called an associate. So the other company will be called an associate. So all of these companies are called investee companies. Investee companies of the parent. So all of these companies, B, C, and D, are investee companies to the parent. But right now, B, I have said, is a subsidiary due to the acquisition, which lies between 51 to 100. 50% exactly is a joint venture. Then 20% to 49%, this is an associate. This is an associate. So in an exam scenario, you will be given statements for A, B, C, and D. So remember that in B, C, and D, the parent has an interest. The parent has an interest. So the parent had acquired B, C, and D. So since you will be given statements of all the companies, now the parent has that capacity, it has that opportunity to prepare consolidated statements so that they look as if they were one. Because if it's an income statement, let's say income statement, So the income statement, you will be given the statement of A, B, C, and D. A, B, and B, C, and D. So the parent would have now to prepare consolidated statements by taking the operations of the other companies, that is B, C, and D, so that it presents one statement. They look as if they were one entity. So that is why you will be told, prepare consolidated statement of profit and loss. Statement of profit and loss is just an income statement. So you need to understand, when you have subsidiaries, when you have joint ventures, and when you have associates, when the subsidiaries, joint ventures, and associates, as the parent, how are you supposed to do the consolidation of those companies, of those B, C, and D, the subsidiaries, joint ventures, and associates? How are you supposed to prepare those consolidated statements? Which major adjustments you are supposed to make? Which major adjustments are supposed to be done? That is what you have to understand, because you will be given, yes, an income statement. You will be given a statement of financial position, and at the same scenario, you will be given an additional information. So are you capable of interpreting that additional information so that you know if it's, for example, now unrealized profit on stock? How are you supposed to identify this? If it's unrealized profit on fixed asset, how are you supposed to identify that this is unrealized profit on fixed asset and the way it is supposed to be adjusted? If there's an aspect of goodwill which is supposed to be computed, which method am I supposed to use? And where am I supposed to record that? If there's intergroup owings, how am I supposed to know that this is an intergroup owings? And how am I supposed to deal with these intergroup owings? If there's cash in transit, how am I supposed to identify cash in transit and at the same time know that this cash in transit is supposed to be adjusted here and here? So that is what I want to do for today. So I tell you that when there's unrealized profit on stock, this is how you identify, this is how you compute, and this is where it's supposed to be adjusted. If there's unrealized profit on fixed asset, this is how it arises. This is where it's supposed to be adjusted in the statements. So let's start generally from the introduction by looking at the definition of key terms. Then we go ahead to check on those major adjustments which are supposed to be done. Then we look now at the formats of these income statements, statement of changes in equity, and the statement of financial position, how you are supposed to consolidate them, how you are supposed to prepare them in a direct manner. So there is a notes I've shared to your group. Those are the notes we will be discussing as I do some major presentations maybe in the whiteboard, but we don't have to write a lot of things. I will be writing what is important, what can assist you to do a consolidation question. A question which never misses in any exam, a question which contains more than 18 marks, beside published financial statements and the financial analysis. So we always say that group accounting is the act of bringing different entities under one entity. So that is what I've said. That is what I have even interpreted in the whiteboard. So the main objective of business combination is to enable the acquirer, the parent is the acquirer, to report on the operations of the acquiring companies as if they belong under one economic entity. So you have to consolidate. As the parent, you have to consolidate your investee companies so that they look as if they were one. So you look as if you are one. You don't have now to show all those statements which would be given. So key terms I've talked about the parent being the main company which acquires the others. We have talked about the subsidiary, an entity which is acquired by the parent, and the parent owns more than 1/2 of the shareholding. That is 51 plus. So circumstances, an entity is considered to be a subsidiary. We look at the percentage, that is the aspect of 50 plus 1. We look at the parent being represented by in the bond, that is not by, but in the bond. We look at the parent, if the parent is participating in the financial and operating policies of that other company, we consider that other company to be a subsidiary. So we look at three scenarios. For a company to be considered a subsidiary of the parent, we look at the percentage. We look at the point whereby there's a representation of the parent in the board, and if the parent is participating in the financial and operating policies in the other entity. So there's someone who is saying, please add me to the WhatsApp group. So that is why I said for the new members who are around, who are not in the group, I will share my number. We talk after the class. So how you will be added to the group, what it takes to be added to the group. So for today, you can be around if you are around and you are not there in the previous classes. So the next thing we have to talk about is non-controlling interest. So a non-controlling interest is whereby you find, let's say, for example, we have A acquiring B up to 80%. I've already explained that B is what? Is our subsidiary, because this percentage is lying between 51 to 100. So meaning that the percentage which is unacquired in B is 20%. And that 20% is what we call non-controlling interest. Non-controlling interest. NCI, the non-controlling interest. So the percentage which is with the minority shareholders, the percentage which the parent doesn't control in the subsidiary company. That is the percentage with the minority shareholders. We call non-controlling interest. The percentage are unacquired in the subsidiary company. And the next thing we talk about is all about subsidiary, associates, and joint ventures. So for subsidiary, you will find that on some cases, you will find these. You will find that A had acquired B and C. So there's a student who asked me this question today, and I think you are around. So you find that, for example, we have B acquiring 80%, that is A acquiring 80% of B, then B acquiring C, let's say up to 60%. So meaning that B is a subsidiary to A. B is a subsidiary to A. Then C is a subsidiary. Subsidiary. B is, that is C is a subsidiary to A. C is controlled by A indirect through B. So for B, it's controlled 80%, but for C, it's controlled, you take 80% and 60%, because it's a control through B, and A was controlling B up to 80%. It's only that A used B to invest in C. So the control in B is 80%, but the control in C, you have to take 80% times 60. But at this level, they cannot bring an aspect of subsidiary at your level, financial reporting. What they will do, they will make sure that this percentage down here is less than 50. It can be around 40. So that this C will remain to be an associate at a certain percentage, which is 80% times 40. That is 32. So at your level, they cannot ask about subsidiary, but they can bring a structure of this kind. But this percentage will be less than 50. And that one qualifies to be an associate or a joint venture. At your level, they cannot test subsidiary. They can test the aspect of subsidiary, associates, and the joint ventures. This one will be well addressed in questions. For now, let's continue. But you have an idea what is a subsidiary. When you will be in the advanced level, that is when you will do illustrations concerning subsidiary. So for associates, joint ventures, we have explained which type of investing companies are these. So meaning that the key terms, we are done with them. We are done with the key terms. The next thing we have to talk about is all about the legal and the institutional framework of group accounting. So when we talk about the legal is according to the law. From our learned friends, legal, it's according to the law. Institutional framework, institutional is according to accounting standard. Accounting standard. So accounting standards. Like now here, when I talk about legal and institutional framework of group accounting, according to the legal, it always states that section 154 subsection 1 of the Companies Act says that when a subsidiary, when the parent has a subsidiary, it has to prepare consolidated statements and present these consolidated statements during the annual general meetings. That is section 154, subsection 1. But you don't have to understand all those things, all about sections and all. So according to the law, when the parent owns a subsidiary, it has to prepare consolidated statements and present these statements at the annual general meetings to the relevant shareholders, the people who have interest to the company. But now, there is a scenario whereby the parent can be exempted from consolidating subsidiaries. On which scenario the parent can be exempted from doing the consolidation of the subsidiaries? If the subsidiaries were acquired and they were to last for a period of less than 12 months. Parent may acquire a subsidiary, na hii subsidiary either last na parent for a period exceeding 12 months. On this scenario, the parent will be denied that opportunity to consolidate the subsidiary. Another scenario whereby the parent can be denied the opportunity to consolidate the subsidiary is whereby the financial instruments of the parent, the shares of the parent, are not trading in the relevant market. You know which market I'm talking about? The securities market, where shares are sold. So then the stock exchange. So if the parent's shares are not publicly trading in the market. Another reason is whereby the parent is not filing the relevant returns with the relevant authority, that is KRA or the Capital Market Authority. Another reason is whereby the parent, you find that it's controlled by another entity. Like now, the aspect of A acquiring B, then B acquires C. Remember, like now in this scenario, B will be behaving like it's a parent of C. Then A is that of B. So A might be denied the opportunity to consolidate C because that already has been done by B. So those are the reasons. Then when we talk about institutional framework of group accounting, so remember, never worry for now, just reason and understand what I'm talking about because you have the notes. So never worry about the notes, you have them. So it's all about understanding and maybe making some short notes. So when we talk about the institutional framework, the accounting, according to International Accounting Standards 27, it says the same thing I've said, the same thing I've explained from legal. It's only that now here you have to say, according to International Accounting Standards 27, when a parent has a subsidiary, it has to do what? To consolidate that subsidiary and present consolidated statements during the annual general meeting to the shareholders. Which are the exemptions? When the parent can be denied this opportunity to consolidate for the subsidiaries, the exemptions remains to be the same as that of legal framework. So the next thing to mention is all about how you are supposed to do goodwill. So the next thing is all about goodwill. So a question to the class. When you buy any business today, you might be told to pay this. Nowadays, even when taking some spaces here in Nairobi, rental areas, not even rental areas, but commercial areas. You are told to pay goodwill. What's this? Which definition can you give to goodwill as a layman? Now, there's a person who doesn't understand goodwill. He has come to you as a professional and asked you to explain what's goodwill. So what can you explain what's goodwill?
I think I'd say goodwill is an intangible asset. Intangible meaning you can't hold it like physically, that is associated with a company because of its good reputation or good business.
If that is the case, I
So
can. So as also Daniel has said in the chat that it's a good reputation that one can leverage on. Yes, that is a good definition. So due to that good reputation, there's an economic return you get from that business. So now, according to IFRS 3, we always say that goodwill is an economic benefit expected from an asset. So this economic benefit can only be gained through the good reputation you have been talking about. So goodwill is all about the economic benefit which can be expected, the future economic benefit expected from an asset. And goodwill is inseparable from the asset itself. You cannot separate goodwill from the asset. Let's say mention let me mention about the blue chip companies in the country, like now Safaricom. So it has a good reputation in the communication sector. That is why it has a lot of customers. Due to its good reputation and the customer base it's controlling in the market, remember that it's making wonderful profits. So the return, the economic benefit, it's getting through the good reputation it hold. So how do you check for this now? Practically now in, let's say not even practically, theoretically in consolidation now. When you are told, for example, A and acquired B, then now remember that the parent will be computing now the goodwill of B. It has to check the goodwill of B. How do you go about it? So we have to take the purchase consideration. We have to take the purchase consideration. We always take the purchase consideration. We minus the share of net assets. Share of net assets acquired. The purchase consideration. The purchase consideration on some scenarios, it would be cost of investment. The cost of investment. The cost of investment. So the amount paid. So these are about the amount paid. Amount paid to acquire investee companies. Amount paid to acquire investee companies. So what about the net assets? These are equity components. These are the equity components. You know them. Ordinary share capital, preference share capital, share premium, retained earnings, revaluation. So the equity components, the equity components. So that is it. Purchase consideration minus the share of net assets acquired in the investee company. We have two methods which can be used in the computation of goodwill. The first method is all about full method. So the methods which you need to know. The method which you can use. We have the full method. In some cases, or in some books, you will find that they call it fair value method. Fair value method. They call it fair value method. Number two, we have the partial method. We have the partial method. So the full method, stroke fair value method, or the partial method. So the full method is applicable only in the computation of goodwill of the subsidiary. But at the same time, the partial method can also be used in the computation of the goodwill of the subsidiary. So how will you be able to know that I'm supposed to use full method in the computation of the goodwill of that subsidiary? Or how am I supposed to know that I'm supposed to use the partial method? So for you to use full method in the computation of goodwill of the subsidiary, in that subsidiary, or in that relevant question it will be given, you have to be told that the non-controlling interest, the NCI, is measured at its fair value. The NCI must be stated at its fair value. Let's mention something here so that you will be able to understand what I mean. So we talk about full method. So the full method. So for the full method, for it to be applicable in the computation of goodwill, so the fair value, that is the NCI, must be stated at its fair value. NCI, non-controlling interest, must be stated at its fair value. Must be stated at its fair value. So that is the first scenario. So number two, if you don't have the fair value of the NCI direct, you can be given an information which will aid in the determination of that fair value of NCI. So which is this information which can be provided? Which information can be provided? So if the subsidiary, if you are given what? If you are provided with the market price, if provided with the market price of the ordinary shares of the subsidiary as at acquisition date. If provided with the market price of the ordinary shares of the subsidiary as at acquisition date. This one can be used in the determination of the fair value of the NCI. How will you go about it? This is how you will get the NCI fair value. You take the percentage of the NCI. You multiply with the number of ordinary shares. Number of ordinary shares in that subsidiary. Subsidiary times market price. Market price, it's again the fair value. It's the same as the fair value. So wasikuwa wamekupea fair value, waanza kutafuta market price. So it does the same thing. So that is how you arrive at the NCI fair value. Either. So in a question whereby you are given either, you go with the full method. And that takes me to the partial method. So if this information is not there, if this information I've written here is not present, you go for partial. So when using full, there's something I needed to mention here. When using full method, the goodwill you get is attributable to the parent and to the non-controlling interest, the NCI, when you are using the full. So when this information is present, then you have computed your goodwill. That goodwill will be attributable to the parent and to the non-controlling interest. But now I've said if this information is not present, you have to use the partial method. Under the partial method, the goodwill is attributable only to parent. is attributable only to parent company. Any question? Or you are writing this one?
Yes.
So 2 minutes you write, or 1 minute you write. So we have covered that one, that one. So this one is covered. So you can see right now when you're using the full method, these are the format looks like. So remember that we said it's purchase consideration minus share of net assets. But for you to use this full method, this favor of the NCI must be present. So that we have the first column for the parent, second column for the non-controlling interest. So that you take the purchase consideration, you put under the parent, the fair value of the NCI under the NCI. Then now, the share of net assets. Remember that the share of net assets are the net assets of the investee company which was acquired. So if the investee company, let's say for example, it was A which acquired B. It was A which acquired B. So you have been given the fair value of NCI in B is 200. So that is what you put in the NCI. Then the purchase consideration is that the parent paid. That is what you put under the parent. Then for the net assets you raise is that of B. So let's say you are given ordinary share capital of B is 200. Then this B was acquired up to 80%. How are you supposed to share under the parent and NCI? So for the net assets, for this one to be shared, so it means that 80% of 200, which is 160, goes to the parent. Then 20% of the 200, that is 40, goes to the NCI. That is how you share according to the format which I projected. So the purchase consideration is what is paid by the parent. Favor of the NCI is what is in the NCI under B. Then the net assets are the net assets of B. Like now, ordinary share capital, which is 200, it's shared 80% to the parent based on the percentage the parent acquired B, then 20% of the same goes to the NCI. With more emphasis on two items. Which are these two items you need to emphasize more? The retained earnings and the revaluation reserve. So the retained earnings and the revaluation reserve, the figures you are supposed to use are those as at the acquisition date of that relevant investee company. As at that time that investee company was acquired, the retained earnings was, the revaluation reserve was. So you need to know how to compute them. If they are not provided direct, there's a way the examiner will provide that information, and that one will be well addressed when I do an illustration. I will do an illustration to address that. So you get the total goodwill. You know that goodwill is impaired. It's like fixed assets are depreciated. Goodwill, you impair. Impairment is an expense. The net goodwill is a non-current asset. So for the partial method, now this one is just for the column of the parent. There's no aspect of non-controlling interest. There's no aspect of non-controlling interest. So there's no purpose of doing this illustration because I will do illustrations from the past papers. So let's skip that. Let's go direct to the key adjustments in group accounting. So for the illustration of goodwill, I will address that when I do an equation. For now, you have understood on which scenario you use full method, on which scenario you can use partial method. For now, know that. Then when we come to a question, a 20 marks question, I will start from that goodwill. I do income statement, statement of financial position. So which are the key adjustments done in group accounting? My good people. So key adjustments in group accounting. So the key adjustments in group accounting, number one, we have unrealized profit on fixed unrealized profit on stock. Number two, we have unrealized profit on fixed assets. Number three, we have UPS, we have UPFA. We can talk about revaluation gain. We can talk about intergroup owings. But before I talk about those intergroup owings, let's see which are other adjustments made here. So the last one here, number 4, is all about the dividends. Dividends paid by the subsidiary. The dividends paid by subsidiary. Dividends paid by subsidiary. Then number 5, we have to talk about intergroup owings. Number 6, we have to talk about cash in transit. Number 7, we have to talk about goods in transit. So those are the major adjustments which you need to understand. And this is what builds additional information. Beside the goodwill, this is what builds additional information. There's nothing other than this. So once you will understand that this is unrealized profit on stock, I will be using the word UPS. Unrealized profit on fixed asset, UPFA. I will be mentioning about UPS, UPFA. So how do we arrive at UPS, UPFA, revaluation gain, dividends paid by subsidiary, intergroup owings, cash in transit, goods in transit? How are you supposed to adjust them in the statements? That's all for a 20 marks question. And this one can be either. These adjustments can be either whereby you find that A had acquired B, C, and D, B, C, and D. So let's say subsidiary, joint venture, associated. So they can happen either with these companies, B, C, and D. A was transacting with B, C, and D, but they will only be adjusted when they occur between A and B only, because A controls B. That is where there is a control. In C and D, it's just an interest, which is here, but not a control. We call this interest significant influence. Significant influence. This is where we have control. So any of these adjustments between B and C, which is a joint venture, and between A and D, which is an associate, even if they appear in the additional information, you don't eliminate them anywhere. You disregard, you assume that they were not there. So you only consider them when they occur between parent and subsidiary. Let's mention about the first one, UPS. UPS. How does it arise? How are you supposed to compute for that? So UPS, unrealized profit on stock. This is whereby you find that we have a parent, we have a subsidiary. So I will be using those examples whereby these transactions occurred between parent and subsidiary, because I have explained that if this occurs between associates and joint ventures, that is with the parent, we don't consider that. So, unrealized profit on stock, you find that A sold goods to B, parent sold goods to the subsidiary at a profit. Parent sold goods to the subsidiary at a profit. That is meaning that the parent realized the profit. But now, by the end of the year, when we are closing our books, you will find that this subsidiary, those goods it received from the parent, a certain fraction of those goods, they are unsold by the end of the year. So meaning that they are in the stock of that subsidiary. So in those goods which are unsold, there's a profit which is done what? Unrealized. So that is unrealized profit on stock. So the unrealized profit on stock, it's not only that when the parent is selling to the subsidiary, it can be two-way. Even the subsidiary can sell to the parent. And you find that the subsidiary had realized the profit and that the parent did not realize the entire profit because the parent never sold all the goods by the end of the year. So when adjusting in your statements, you need to know, is it an upstream sale or a downstream sale? So UPS is computed by taking unsold goods times profit margin times the profit margin. On some scenarios, you can be given profit markup. So if provided with profit markup, change to margin. So how do you change profit markup to margin? If you are given markup of A over B, our margin will be A over B plus A. Example, if you are given a half, this one would be a third. If it's 2 over 5, this one will be 2 over 7. Are we together? Yeah. I think I can remove this one. It's not that important. So what you need to know how to change. Another thing you need to understand is what about now. To avoid profit overstatement due to this UPS. So to avoid what? Profit overstatement. To avoid profit overstatement. UPS will be eliminated. UPS will have to be eliminated. That is, if it was due to downstream sale, if it was due to downstream sale, what are you supposed to do? If it was due to downstream sale, eliminate the overstated profit. The overstated profit in the parent company books by, so to eliminate profit, our retained earnings will be debited. Debit to group retained earnings. Retained earnings account. Credit inventory account, the group, inventory account. Credit the group inventory account. That is due to downstream sale. So to avoid profit overstatement, UPS will have to be eliminated. That is, if it was due to downstream sale, UPS is eliminated. UPS is eliminated. So if it was due to downstream sale, it's eliminated. So UPS is eliminated. UPS is eliminated in the, oh, this is just a repetition. UPS is eliminated. UPS is eliminated in the parent company books. In the parent company books by you debit the group retained earnings account and the group inventory account. Because when you debit your retained earnings account, umepunguza hiyo account, imepungua na hiyo UPS. Ukicredit inventory, again, imepungua. So which means that you have avoided the profit overstatement in that parent books. Vice versa is true for upstream sale. But now we cannot say that. We have to write something because there's something I have to introduce under this accounts to be adjusted. There must be an aspect of NCI, the non-controlling interest, which must be affected. So to avoid profit overstatement, UPS will be eliminated. That is, if it was due to upstream sale, UPS will be eliminated in the subsidiary company by debiting retained earnings. Again, you debit NCI account, then you credit inventory account. That is due to upstream sale. So meaning that, how do you share these among the three? So let's say UPS was 200. And the A had acquired B up to 80%. So how do you share these among these accounts? So you take 80% of the 200 of the UPS goes to the retained earnings, 20% of the 200 under NCI. Then now you credit the inventory account with the total 200. You credit the inventory account with the total 200. Nothing else you need to understand in UPS. So when given margin, you change to markup. Or when not given margin, if you are not given margin at all, you can compute this by taking your profit over the selling price. The next adjustment is all about unrealized profit on fixed asset. Unrealized profit on fixed asset. So the unrealized profit on fixed asset, what is this? The UPFA, in short. How will they test the UPFA in an exam scenario? You will be told that the parent sold a fixed asset to the subsidiary. For example, the parent sold a plant to the subsidiary. So remember that for the fixed asset, it's supposed to be a transfer from the parent to the subsidiary because these are group members. So, but now, if you find in a situation whereby, or which that will be the situation if they test, they will tell you that the parent sold the fixed asset to B. The parent sold the fixed asset to the subsidiary, reporting a profit of a certain percentage. So when a fixed asset is sold to a subsidiary, when it's sold at a profit to the subsidiary, that subsidiary which receives that fixed asset will never resell it. The fixed asset is not meant for resale. Meaning that if A which is the parent, transferred that fixed asset to B at a profit. A realized the profit, but B will never realize the profit. Will never realize the profit because he will never do what? Resell. He will never resell that fixed asset, meaning that that profit realized by A will never be realized by B. And that is why I will say that that profit which is unrealized by B is realized by that profit which is unrealized by B was realized by A. So here we call it unrealized profit on fixed asset. So meaning on this scenario, the profit of A is overstated by what B never realized. The profit of A is overstated by what B never realized. In group accounting, we have to avoid profit overstatement. In A, we have to eliminate that profit. First, before we eliminate this profit, how are you supposed to compute for UPFA? Is equals to transfer value of the asset, times profit margin. How do you determine this UPFA? That is the case. Then when eliminating in the books of the parent, you are supposed to debit the retained earnings account, debit the retained earnings account, credit the PPE, property, plant and equipment account, credit the PPE account. Due to this due to this transfer of a fixed asset, there arises something called depreciation overcharge. Because you will be told that when A was transferring this asset to B, he charged depreciation. Again, B receiving that asset, he again charged the depreciation. In short, they will not be that specific, but you will be told that the group charged depreciation on the asset at 20%. What is the meaning of the word group? Group is the parent and its subsidiaries. And here we have the parent being A and the B is a subsidiary. So when they say that the group charged depreciation on the asset at a certain percentage, they mean that both of them, they subjected that asset to a depreciation, meaning that they understated the value of the asset. They understated the value of the asset. So we have to determine that depreciation overcharge. How do you determine depreciation overcharge? You take your UPFA, you multiply depreciation rate, or you take your UPFA, you divide with the remaining economic life, the years, the useful life, that is. Then, how do you adjust this now? Because they had understated the value of the asset. Where do you adjust your depreciation overcharge? So now, for you to avoid that understatement of the value of the asset, you are supposed to debit the PPE account and you are supposed to credit the retained earnings account. You credit the retained earnings account. We are done with the UPFA. We are done with the UPFA. The next thing is concerning revaluation gain. Revaluation gain, which I clear this.
Wait, kidogo.
I think that is fine.
Yes.
So the next adjustment is concerning revaluation gain. The revaluation gain. So what is revaluation? So revaluation, we always say that it's the difference between the fair value of an asset. The fair value is the same as the market value of an asset and its carrying amount. So the difference between what? Difference between the fair value, which is again what? The market value, and so the difference between the fair value or market value and the carrying amount. Carrying amount is called what? The net book value of what? Of the assets. So the difference between the fair value or market value and the carrying amount or net book value of the assets. Where obvious, the fair value is higher than what? Than the carrying amount. The fair value is higher than the carrying amount. Or wanaweza kuchanganya kidogo, waseme the carrying amount is less than the fair value. It's just the same. This is just the same thing. The fair value is higher than the carrying amount, or the carrying amount is less than the fair value. So that is a revaluation gain. Or they can give you the fair value and they give you the carrying amount. So meaning that in a question they can provide the fair value and they can give you the carrying amount. So this one you will be told, for example, is 300. This is 290. So revaluation is 10. The difference, the difference of the two. Or they can give you this direct by saying this, but that the fair value was higher or was in excess, is higher stroke in excess. The fair value is higher stroke in excess of the carrying amount. The fair value is higher stroke in excess of the carrying amount by 10. That is again revaluation gain. Or the carrying amount is less than the fair value by 10. That is again a revaluation gain. Where do you adjust? Where do you adjust this? Where do you adjust the revaluation gain? So with revaluation gain, you debit what? And you credit what? With revaluation gain, you debit PP account, you credit your revaluation reserve account. You credit your revaluation reserve account. That is revaluation gain. So revaluation gain leads to what? Leads to depreciation under charge. It leads to depreciation under charge. Because the figure, this value, which the asset revalued with, that figure has not been subjected to depreciation. Like now the 10 we were mentioning, that value, the 10 has not been subjected to depreciation. That is why I would say that we did a depreciation under charge due to the revaluation. So we need to know which is the depreciation inside that revaluation gain. So how will you know the depreciation under charge? You take your revaluation gain, you multiply with the depreciation rate. Or you take your revaluation gain, you divide with the remaining economic life. Where are you supposed to adjust that? Anyway, I think you are done with this. So I have said it leads to depreciation under change. So depreciation under change. Depreciation under change, which you take your revaluation gain, you multiply with the depreciation rate, or you take your revaluation gain, you divide with the remaining useful life. With the remaining useful life. Then where do you adjust this depreciation under change? Where are you supposed to debit? Where are you supposed to credit? Because if you did a depreciation under change, your profit was understated, and the asset was understated. Was understated or overstated? Sorry for that. Let me withdraw that statement. If you did a depreciation under change, it means that the value of the asset was more and your profit was more. So both of them, they were overstated. So to correct that, it means that under the assets, you have to do what? You have to minus. And under the retained earnings, you have to minus. Minusing under the retained earnings is debiting. Minusing under the retained earnings is debiting. And the minusing under the asset account is crediting. So dividends paid by the subsidiary companies, that is another adjustment which is done. So this one will only be applicable if the subsidiary is acquired during the year. If subsidiary is acquired during the year under consideration. Only applicable if subsidiary is acquired during the year under consideration, meaning that if our financial year was running from January to December, for us to use these dividends paid by the subsidiary, our subsidiary must have been acquired somewhere, let's say 1st September there during the year. So that is why now I will be having pre-acquisition period, and I will be having post-acquisition period. I will be having pre-acquisition period, and I will be having the post-acquisition period. And you find that this subsidiary paid some dividends by the end of the year. It paid some dividends at the end of the year, but it was acquired during the year. So I will consider these dividends to accrue throughout the year, so that we apportion them based on the pre-acquisition period and post. Like now here, if the dividends are 200, which they paid, for the pre-acquisition period is 9 months, this is 3. And let's say the parent had acquired this subsidiary up to 80%. Let's say the parent had acquired the subsidiary up to 80%. So for pre-acquisition period, I will talk about 9/12 times what? 200. And this one will be 3/12 times 200. So which accounts are affected? So this pre-acquisition period affects the goodwill. So the figure you get from here will be used as net assets, as part of net assets, in the computation of goodwill. So this one is credited in goodwill. So credit goodwill as what? The figure you have as part of net asset, beside ordinary share capital, share premium, retained earnings, revaluation reserve. What about post-acquisition period? This one is credited in the retained earnings account. That one is credited in the retained earnings account. That is what you need to know for dividends paid by subsidiary companies. So other things which are remaining now is they are very easy adjustments. Intergroup owings, cash in transit, goods in transit. Few seconds, are you done with this? Remember that the notes I shared, they have all of these. Even in addition, if you check in that UPS, there's a small illustration. How do you compute this UPS? Based on the explanations I've given, we do a small illustration. I have avoided doing all of those illustrations because I will come to address those illustrations when I do what? A question. So for now, I wanted to create, at the back of your mind, what is UPS? What is UPFA? What is revaluation gain? What is dividends? Oh, I think we go ahead and talk about intergroup owings. An owing, you know, it's an outstanding amount, an outstanding balance. Date. In Kiswahili, we say deni. So intergroup owings. So intergroup, between who and who? Parent and subsidiary. So let's say if there's an outstanding balance between parent and subsidiary, A owes B 200 million, And this amount by the end of the year, it has not been settled by A. When we will be closing our books, the amount has not been settled by A. This amount is not supposed to be carried forward to the next financial year. Hawawezi endelea kudaiana mwaka ujao. Kwa nini? Because by the end of the year, A will consolidate B. He will take everything from B and share some small percentage to the minority shareholders. So meaning that A, even if there was anything even which was owed by B to A or A to B, everything in B is owned by A. It's only that after doing the consolidation, then minority shareholders are given some small share based on the profit after tax of this B. And that one means that this amount is not supposed to be carried forward to the next financial year, because A will have to consolidate the subsidiary fully and take everything from there. So this amount is supposed to be done what? Disregarded or to be cancelled. Let us say that. To be cancelled out in the current year. How do we do this? Which account is debited? Which account is credited? We debit the group. That is, we debit the group payables account. We credit the group receivables account. Then now, these intergroup owings, in some extension, it goes hand in hand with something we call cash in transit. It goes hand in hand with this. Because you will find, for example, if you were told that A owes B 200, in the books of A, that is in the receivables of A, it shows it's 200, which in the note, because now here, if we say A owes B, A is the one who's supposed to pay B. So in the books of A, let's say in the books of A, it shows that the amount is not 200. But in the books of B, it shows that A is supposed to pay 200. A is supposed to pay 200. But in the books of A, let's say it was showing by the end of the year that A is supposed to pay 150 instead of 200. So A was owing B 200. In the books of B, it shows that he is supposed to receive 200 from A. But by the end of the year, the books of A are showing that A is supposed to pay 150. Why? Because A had paid 50. It's only that this amount is in transit. It has not been received by B. It's only that the amount is in transit. So how do we adjust this aspect of transactions taking place this way? So we consider 150 to be the correct amount which is owed by now. 50 has been paid. 50 has been paid. So what I'm supposed to do with the 150, this is what you do. This is what is outstanding. You forego. So the group payables and the group receivables is adjusted. Then the 50 which was in transit, that is what is adjusted here. So you debit cash, stock bank. You credit receivables. So meaning that this 50 and the 50. We are done with cash in transit. and intergroup owings. Finally, we have to talk about goods in transit. We have to talk about goods in transit. So for the goods in transit, you find that these are goods sold, let's say, from A to B for 200 on credit. But by the end of the year, these goods have not been received by B. You will obviously be told that if our financial year is ending 31st December 2022, these goods were received on 1st, let's say on 5th January 2023, some few days after the end of the year. Remember that this financial year would have to be adjusted. These goods would have to be recorded as if they were received by the end of the year. How do we do that? So you debit your inventory. Now we are assuming that they were received by the end of this year. You debit your inventory. Then since they were on credit, trade payables must be increased. Creditors' balances must be increased by crediting. So credit the trade payables. Any question?
Yes, I have a small question
Mm-hmm.
about cash in transit.
Yes.
Is in the books A or B?
So remember that this one was A, which owed B. A is supposed to pay B 200. By the end of the year, instead of the books of A showing that it's supposed to pay B 200, it's showing 150. But remember, in the books of B, it's still showing that he is supposed to receive 200. Why is this showing that A is supposed to pay 150? You will be told that he had paid 50, but this amount were received, let's say, the same time. Instead of being received December 2022, when our financial year was ending, they were received on 5th January, so some few days after the end of the year. Meaning that this amount which was paid of 50 was on transit by the end of the year. So how do we adjust this? So when adjusting this, it means that we assume that now, not even we assume, we have to adjust our financial year, our books of this financial year, our books of the year 2022. We record this 50 in B because now it has been received, even if it was received some few days after the end of the year. You know, after balance sheet events, you need to know that if you don't know, after balance sheet events, when can we open our statement after we have closed it, but before it's presented to the shareholders during the AGM? So this 50 must be received. We record now, it's received by B. When a cash is received, the cash increases. And the receivables, the debtors balances reduces. Then this 150, remember that it's still outstanding. It's only 50 which has been paid. So we said any outstanding balances which have not been settled by the end of the year, they are not supposed to be carried forward to the next financial year, because obviously the parent will consolidate the subsidiary fully and share some percentage to the minority shareholders. So meaning that these outstanding balances will have to be cancelled out by debiting payables account, crediting receivables account. I think I have answered you, Peter.
Okay, understandable. Thank you for.
So even I can see Susan was asking, does it mean you add 150 to both group payables and group receivable? Susan, no. Because when you debit your payable, you have deducted. Remember that payable is a liability account. If I was to prepare this way, Susan, if I was to open these accounts, the three accounts, if I was to open the first account be my receivable account, the second account be my payable account, the third account, let's say it was cash, due to cash in transit, cash or bank account. So let's now record the aspect of this 150 and 50 here in these three accounts. Remember that the receivable account, the balance brought down is on the debit side. This balance brought down is on the credit side. The cash, the balance brought down is on the debit side. So when recording now the owings, we credit here the 150. And here we debit the owings. So debit payable, credit receivable. I'm using that. You have minus D, you have minus D. So minusing receivable, you credit. Minusing payable, you do what? You debit. So the cash in transit, CIT, is debited here and it's deducted here because it has been paid. Susan, it's not okay now. You can see it's not just adding.
Yes, thank you.
So I think those are the adjustments I mentioned. So let's check anything we have not done. Because already I have done all of those adjustments. So anyway, now what you need to know is all about how we do now these, how we do this consolidation direct in the books. How we do it direct in the books. That is what you need to understand. Let's say, for example, we have, other than what I've been saying, debit, credit. When doing in a question, I don't use the opening of T accounts. I don't open T accounts. I don't. So never worry, because I know many students, they don't like opening T accounts. But you have to understand what you do. So it's a group accounting. So let's say, for example, you have a, because these are the kind of structures you would find. Because I don't want to mention about all those structures. You will find structures of this kind, whereby this is acquired 80%, 50, 30. So these direct acquisitions. This is what you can find at your level. Or they give you a structure of this kind. A acquiring B, A acquiring C. So this one, I said it will be 80 or 40%. At your level, they cannot make this one to be more than 50. This is horizontal structure. The one whereby the investee companies are acquired direct. And this one is called vertical. So for the horizontal structure, like now here we have A acquiring B. So the control is 80%. So meaning that the NCI is 20%. Then in C, they have just an interest of 50%. The other 50, we don't know who is in possession of that. Then in D, again, there's an interest of 30%. Under this and this, there is no NCI. The NCI is only under subsidiaries. The NCI is only under subsidiaries. So on this case, B is controlled 80%. So NCI is 20%. Then C, A has an interest in C. A has an indirect interest in C. We can talk about indirect interest in C. So how do you know that indirect interest? You take 80%, you multiply by 40%. So that is 32%. So meaning that when consolidating B, you will be consolidating that B as a subsidiary. Then C will be consolidated as an associate, but at 32%. So let's say now you have scenario 1 or even scenario 2, because even this one, it's just subsidiary, that is subsidiary, joint venture, associates. Subsidiary, associates. So now, how do you consolidate? How will A consolidate these companies directly in a question? Now, if it's from revenue, going to cost of sales, going to what? Going to expenses. How do you adjust? So this is what is supposed to be done. So that one is well explained in the notes. I don't want to write a lot of things. So I want just to display notes. We talk from there. So from notes, let's look at income statement. How you do the consolidation direct. The income statement. How now you go with it in an exam scenario. So this is now if it's revenue, you take the parent plus subsidiary. Then the only thing you deduct under the revenue is the intergroup sales. This intergroup sales is that of the parent and subsidiary only. And this intergroup sales is the one which took place in the financial year under consideration. That's all about cost of sales. That is revenue, sorry. For the cost of sales, you take the figure of the parent plus subsidiary, you minus intergroup sales. The same you deducted under revenue, you add the UPS. We have explained what's UPS on closing stock, meaning that if the goods were unsold by the end of the year under consideration. If the intergroup sales took place in the previous year, remember that the UPS will be that of the end of the previous year. So it will be an opening in the current year. So UPS on closing stock, you add. UPS on opening stock, you minus. You add depreciation under change, which is due to revaluation. You minus depreciation over change. So you add under change, which is due to revaluation. You minus depreciation over change, which is due to sale of a fixed asset. So you get your gross profit after taking cost of sales from your revenue. You go to incomes, you take the parent plus subsidiary. On the scenario now, whereby you find that all the other investee companies paid dividends, because for revenue and cost of sales, I have only considered parent and subsidiary transactions. So the first point whereby I introduce now the associates and joint venture is under investment income. So after taking parent plus subsidiary, here under investment income, if the subsidiary, if the associate, if they were present, that is, if the joint venture paid dividends or interest, you deduct from investment income with the percentage which the parent controls them. So if it's 80% here, 50%, and 30%. So because that dividends or interest, you will find that it was recorded under the parent as income. So the parent is not supposed to recognize those dividends or interest as income. That is why we are deducting. So here you consider all the investee companies. So then you go to expenses. Administrative expense is just taking the parent plus subsidiary figures. Selling and distribution, the parent and subsidiary. Impairment you introduce there is based on the goodwill. You will do a working on goodwill. You get profit before interest and tax. Finance cost, you take parent plus subsidiary figures. Then again, now here you introduce what you are getting from the associate or a joint venture as the parent. So after those associates and the joint ventures paid tax, you are entitled to your share. So if it was 50% in joint venture, you take that 50% of the profit after tax in the joint venture as your income. If it's in the associate, you take if it was 30% of that profit after tax, that is an income to the parent. Profit before tax, so you minus the income tax of the parent and subsidiary, you get profit after tax, you add other comprehensive incomes, e.g. revaluation reserve, total comprehensive income you get there. Then you have to share something to the minority shareholders, the NCI, based on the profit after tax of the subsidiary, because the NCI is under the subsidiary. So that profit after tax of the subsidiary, there is something which is supposed to go to the minority shareholders. But you cannot share direct by taking the percentage of the NCI times the profit after tax. No. That profit after tax of the subsidiary might have been understated or overstated. Why? Because of this. So you need to adjust that profit after tax in subsidiary by deducting UPS if the sale was upstream. Because if the sale was upstream, the subsidiary had done what? Realized the profit which the parent had not realized. So meaning that the profit of the subsidiary is overstated by what the parent never realized. If there is depreciation under charge, you minus, because you will find that the profit was overstated. If there was depreciation over charge, you add, because you had understated your profit due to depreciation over charge. Then you minus your impairment, because it's an item which is arising due to goodwill, which has not been adjusted. But impairment can only be deducted if we use the full method in goodwill. So that adjusted profit is what you take, you multiply with the profit. You take your adjusted profit, you multiply with the NCI percentage. For the statement of changes in equity, we always consider the retained earnings only. We always consider the retained earnings only. Meaning we take the retained earnings balance brought down of in all the companies which are present, you add the profits for the year, you minus the dividends paid, you add the negative goodwill. The last part for today is this format of statement of financial position. When consolidating statement of financial position, this is scenarios whereby, remember, the parent has associates, subsidiaries, and joint ventures. How do you consolidate direct? Those, as the parent, how are you supposed to consolidate direct? So, under property, plant, and equipment, parent plus subsidiary. What is adjusted in PPE? Add revaluation. Remember that when I was talking about revaluation, I said with revaluation gain, we debit PPE, we credit revaluation reserve. So you add revaluation. Due to revaluation, there is a depreciation undercharge which you deduct. Then you ask yourself, was there a sale of fixed asset? You check for UPFA, you deduct, you add a depreciation overcharge. For intangible assets, is parent plus subsidiaries. Investment property, parent plus subsidiaries. Investment in subsidiaries replaced by goodwill. So you will be given cost of investment, the investment with the parent made in the subsidiary. So that investment, you have to check which is now what's the goodwill of that subsidiary with the parent acquired. For investment in associate and joint venture, we account for the associates and joint ventures using an equity method. I will mention about it later. For the current assets like inventory, after taking the parent plus subsidiary under inventory, you minus UPS, you add goods in transit. Remember, under goods in transit, I said, when I was explaining this, I said, you do what? You debit your inventory, you credit your payables. For the accounts receivable, I even explained some few minutes ago. After taking parent plus subsidiary, you minus intergroup balances. It means that it's credited. Other than crediting under receivables, that intergroup balances is again adjusted in the trade payables. So intergroup receivables, that is account receivable, you minus, after taking the parent plus subsidiary, you minus intergroup balances. The intergroup balances you minus there, it's deducted under payables. The cash in transit, which is minused under the accounts receivable, it's added in cash or bank. And that is what you can see next. Cash stroke bank, parent plus subsidiary. You add cash in transit. For the financial asset at fair value, you add parent plus subsidiaries. Equity components, like ordinary share capital, preference share capital, share premium, you just use the figures of the parent. For retained earnings, non-controlling interest, and revaluation reserve, you do workings. For non-current liabilities, debentures, deferred tax, and loan stock, you just add the figures of the parent and subsidiaries. For the current liabilities, like trade payables, I have already said that after taking the parent plus subsidiary, that intergroup owings, which is deducted under receivables, it's again deducted here. That goods in transit added under inventory, it's again added here. For current tax, interest payable, and other liabilities, you take the parent plus subsidiaries. So this is the format of accounting for the associates using equity method, whereby the associates or joint ventures are initially measured at cost. You add the share post-acquisition profit or reserve, you minus the impairment. For NCI account and retained earnings, this one will be well covered when I do a practical question. So we have come to an end for the session of today. That is what you need to know. To be more specific, we have covered 90% of the introduction, because what's remaining is just the consolidation of associates and joint ventures, of which I've already mentioned that they are accounted for using the equity method. So the only thing I will mention is a bit of the notes for the consolidation of associates and those joint ventures. That is in our tomorrow's session for the first 30 minutes. Then we go direct and do our first question for September 2015, question 1. I think if there's no question, you can come to the end of this session today and you check on those notes. Try to go through them and understand what is group accounting. What are you supposed to adjust here and there? That is what we have been doing from the start of this session. Yeah. It was, I think, a great session. Peter, Susan, Maureen, the likes of Teresia, Mercy.
Tunashukuru mkubwa.
Mnashukuru, msome sasa. Tupatane kesho tukifanya
Kwa
maswali.
kesho sasa. Tutaongea kesho. Tutazidi kuonana kesho.
Tutazidi kuonana kesho. Hiyo ni sawa. So I hope that is good if you have enjoyed the session of today. And for the guys who joined maybe from the other platforms, you can chat me so that we know the way forward. So you are welcome to this platform. You have my contact, I think, for the new guys who are here.